welcome to the deep dive. Okay, so you gave us the sources on Amphenol Corporation's Q3 2025 earnings, and wow, we looked at those headline numbers and just felt this sort of thump. This wasn't just good. The company announced, and I'm quoting here, record third quarter 2025 results. And when you look at the financials, you really get why. Compared to Q3 last year, sales just rocketed up to $6.2 billion. That's a, 53% increase in U.S. dollars?
Massive. Absolutely massive. And the profit side didn't disappoint either. Adjusted diluted earnings per share, 93 cents. That's an 86% jump.
86%.
And tying it all together was that operating margin, also a record, 27.5%, whether you look at the GAAP figure or the adjusted one. That kind of margin, well, it tells you they're not just bringing in revenue, they're executing incredibly efficiently while doing it.
Right. So our mission today is to figure out, what exactly is behind this performance. Is this all just aggressive M&A, buying up growth, or is the core, the sort of day-to-day business, really firing on all cylinders? We need to unpack what record really means here.
Yeah, and separate the acquisition effect from the, let's call it, the underlying pulse of the company.
Exactly, and pin down which market is suddenly demanding so much more of their stuff.
Well, that distinction is key. You flagged the 53% total sales growth, which, yes, is headline grabbing. But when you peel that back, the source material shows that 41% of that growth was organic.
Okay, wait. 41% organic growth on a $6.2 billion quarterly base. That's almost hard to comprehend. For you listening, most big industrial companies, they're happy with, 3%, maybe 5% organic growth?
Lucky, yeah. Low to mid-single digits is typical.
So 41%.
Yeah.
It means demand for their core products isn't just strong, it's like off the charts.
It really is. It shows their internal strategy is hitting the mark perfectly with what's happening out there. And you see that strength in their finances, too. Look at the cash they generated.
Right, liquidity.
Exactly. Operating cash flow hit $1.5 billion. And free cash flow after investments was $1.2 billion. That's a huge amount of cash. Gives them enormous flexibility.
And they definitely used some of that flexibility to reward shareholders this quarter. What was the total? $354 million returned.
That's right. $201 million paid out in dividends and another $153 million used to buy back 1.4 million of their own shares.
They're clearly serious about returning value.
And that message was amplified, really amplified, by the board's decision on the dividend. They approved a, frankly, jaw-dropping 52% increase in the quarterly dividend.
52%.
Yep. Hiked it from 0.165 cents up to $1.25 per share. That kicks in with the payment in January 2026.
Wow. Okay, 52%. On one hand, that's like the ultimate vote of confidence, isn't it? The board saying, we think this cash flow is real and sustainable.
It absolutely signals that.
But on the other hand, isn't that kind of risky? Such a huge leap.
That's the question, isn't it? You have to wonder. Their main driver right now, the IT hardware cycle, well, it can be pretty volatile. A 52% jump is, well, it's aggressive.
Very aggressive.
They're essentially betting hard that this huge demand spike, mostly from data centers and AI buildouts, is going to keep going strong for a good while, long enough to comfortably cover that higher payout without breaking a sweat. It definitely signals they're not worried about a sudden dip anytime soon.
Confidence seems to be sky high over there. Okay, before we get into where that confidence is coming from exactly, let's quickly touch on those profit numbers. You listening might have seen, too, GAAP EPS was $0.97, but the company highlighted the adjusted EPS of 93 cents. Why the difference?
It really comes down to giving a clearer picture of ongoing operations. The adjusted number strips out things that aren't part of the core business performance or things that are kind of one-offs.
Okay.
In this case, the GAAP number was higher because it included about $57 million in excess tax benefits from stock-based compensation. That's related to taxes, not selling connectors,
Like
right?
just not operational.
Exactly. So by taking that noise out, the $1.93 adjusted EPS gives you arguably a more reliable look at their core earnings power for the quarter. It's about consistency.
Makes sense. Okay, let's find the engine room then. The CEO, our Adam Norwitt, he basically pointed right at it in his comments.
He did. He was pretty clear. He said the huge sales growth came from strong organic growth in virtually all of our end markets, which is great, but then he really zoomed in. He highlighted exceptional organic growth in the IT datacom market. That's the hotspot.
IT datacom. And you can really see that focus fire when you break down their reporting segments. They've got three main areas, right? And like two are doing really well, solid performance. But the third one, it's just on another level.
That's a perfect way to put it. It's like two ships cruising nicely and one's a rocket.
Yeah.
So let's see. You've got harsh environment solutions that pulled in $1.5 billion in sales. Total growth was 27%, and the organic piece was a very healthy 19%. That's things like defense, industrial uses, great numbers.
19% organic is definitely strong. Okay, what's the next one?
Then there's interconnect and sensor systems. Sales there were $1.36 billion. Total growth 18% and organic growth 15%. Again, really solid performance for a company this size. Nothing wrong with that at all.
15% organic.
Yeah.
Still very respectable.
But then you get to communication solutions, and the numbers here are just, wow, staggering. Sales hit $3.3 billion. That's more than the other two segments combined.
Right.
And the growth. Total growth year over year was 96%.
96%. Okay, that's huge.
Right.
But here's the kicker, right? The organic number for just this segment.
This is the mind blower. The organic growth rate for communication solutions alone was 75%.
75%.
Yeah.
Organic. So 3/4 of that near doubling in sales came from existing business just exploding.
Exactly. This is where you have to connect the dots. When you see 75% organic growth in a communication segment right now in late 2025, you're basically seeing the physical result of the AI and hyperscaler build-out.
Right. Amphenol makes the guts, the connectors, the high-speed stuff.
Precisely. The high-speed backplanes, the fiber optic systems, the specialized cables that can handle the massive heat and bandwidth demands that these huge AI clusters need to talk to each other.
So when the CEO talks about this revolution in electronics, he really means every big tech company throwing money at AI infrastructure is buying tons of their connectors and cables.
That's essentially it. You just don't hit 75% organic growth unless demand has suddenly gone almost vertical, totally overwhelming what anyone expected even a year ago.
It feels like they were just perfectly positioned.
They absolutely were. They have the tech, they have the manufacturing scale to jump on this massive shift to high-performance computing, especially managing the heat in these packed data centers. That 75% organic growth in comm solutions, that's the number in this whole report, I think.
Hard to argue with that.
Yeah.
Okay, so the core business is clearly on fire, driven by IT datacom. But let's talk strategy beyond that. Amphenol's always used M&A, acquisitions, to broaden its reach. What did they do on that front in Q3?
Well, even with the massive organic story, they didn't sit still. They did complete one acquisition back in August 2025, a company called Rochester Sensors.
Rochester Sensors.
Okay.
Okay, what do they do? Doesn't immediately sound like high-speed data connectors.
No, it doesn't. They're a leader in making highly engineered liquid-level sensors for specific applications. Think industrial tanks, process controls, that sort of thing.
Huh. Liquid-level sensors?
Yeah.
So why would Amphenol, busy selling fiber optics to AI giants, buy a company like that? What's the play?
It's about diversification. Smart diversification, I'd argue. Yes, IT Datacom is white hot right now, but they stick to the strategy of spreading their bets across markets and geographies.
Okay. Don't put all the eggs in the AI basket.
Exactly. Liquid-level sensors are critical for industrial automation, the whole industrial Internet of Things, or IIoT. It gives them a stronger foothold in more stable, perhaps less cyclical industrial markets, kind of buffers them if the high-speed data market ever cools off.
Makes sense. And how big is Rochester?
Adds about $100 million in annual sales, and it fits nicely into their interconnect and sensor systems segment, logically enough.
Okay. And what about those bigger deals they announced earlier? Any updates on Trexon and the CommScope CCS business?
Yeah, quick update there. Trexon, which is another specialized interconnect company, that deal is still expected to close pretty soon by the end of this quarter, Q4 2025. The bigger one, acquiring the CCS business from CommScope that provides connectivity for communication networks. That timeline has shifted slightly. They now expect that deal to close by the end of the first quarter of 2026, so a slight delay there.
Okay. So M&A is still clearly part of the plan. Buying tech to, as they say, expand its range of high-technology interconnect products, but also buying into different markets like industrial sensors for that diversification. Seems like a balanced approach, even with this crazy organic growth happening.
Absolutely. The acquisitions are there to supplement and strengthen, not to be the whole growth story. The organic engine is clearly the main driver right now.
So let's look forward then. Given this incredible Q3, the strong organic growth, the strategic moves, what are they telling us about the rest of the year? Their guidance must be pretty optimistic.
Oh, it is very optimistic. Assuming exchange rates stay put and the market conditions hold, their forecast for Q4 2025 is strong. They're expecting sales between $6.5 $1.0 billion and $6.1 billion.
Okay, and how does that compare to last year's Q4?
That would represent a 39% to 41% increase over the prior year quarter, so continued very strong growth.
And profits for Q4?
Adjusted diluted EPS for the fourth quarter is guided to be between $0.89 and $0.91. That's projecting a 62% to 65% increase year over year. Still huge growth on the bottom line, too.
Wow. So putting it all together for the full year 2025, the trajectory is just incredible.
It really is. The updated full-year guidance is for sales between $22.66 billion and $22.76 billion. That's a 49% to 50% jump compared to all of 2024.
50% growth for the full year on that scale.
And the full-year adjusted EPS forecast, between $3.26 and $3.28. That would be a 72% to 74% increase over last year's earnings per share. They're basically signaling that this massive growth wave isn't just a Q3 blip. They expect it to continue powering through the end of the year.
Remarkable stuff.
Yeah.
And beyond just riding this market wave, what does management point to as their kind of core strength, their competitive edge that allows this?
The CEO, Norwitt, usually boils it down to about three key things. First, that ongoing strategy of market and geographic diversification, like we saw with Rochester Sensors. Don't get too reliant on one thing.
Right.
Second, their expanded technology position, which comes from both internal R&D and smart M&A, making sure they have the leading-edge products. And third, something he often highlights, their unique entrepreneurial culture.
What do you think he means by that, practically?
I think it implies a decentralized structure where different business units can react quickly to customer needs. Maybe they feel that agility lets them serve these demanding IT datacom giants faster or better than more centralized competitors might.
Interesting. So, okay, let's synthesize this. The big takeaway from Amphenol's record Q3 2025. Yes, M&A plays a role, but the absolute core of this story is blindingly fast organic growth, especially that 75% number in communications solutions.
Right. And that segment is basically ground zero for the AI infrastructure build-out. It's being fueled directly by the massive spending in the global IT datacom industry.
So for you listening, the key point is this isn't just some kind of temporary price bump or something. It looks like fundamental, maybe even disruptive demand driven by a huge technology shift.
And the company seems really well positioned to keep riding that wave while also playing it smart with diversification into other areas like industrial sensors.
Okay, before we wrap up, I did notice something interesting, almost buried in their forward-looking statements. A risk factor they mentioned that seems particularly relevant given why they're growing so fast.
Oh, yeah. What was that?
Cybersecurity threats. They specifically called out that these threats continue to expand and evolve, including through the use of artificial intelligence and machine learning.
Ah, right. That's,
It sets up a fascinating sort of paradox for you to think about, doesn't it? Amphenol is making the literal nuts and bolts, the connectors, the cables that enable this whole AI revolution.
But the very AI they're helping to build
Is also making the cyber threats against companies like them, against everyone really, much more sophisticated and dangerous.
That's a really interesting point. How much focus and resource does a company that primarily thinks about copper and fiber now have to dedicate to defending its global operations against AI-powered cyber attacks? Especially when their products are so critical to the very infrastructure being built.
It's like the cost of being an essential enabler of the future, right?
Yeah.
You become a bigger target and the weapons get smarter partly because of what you help create.
Definitely something to chew on, that interplay between the physical hardware and the increasingly complex digital threats.
A great thought to leave things on. Okay, that's all the time we have for this deep dive. Thanks for joining us.
See you next time.